Hello, my dear students. So, welcome to the second part of our discussion for intercompany sale of property, plant, and equipment. So, in this video, we shall be discussing some sample problems and illustrations, no, in relation to intercompany sale of property, plant, and equipment between the affiliated parties. Okay, so we have here our first problem. No? So Spaniflex Pig and Company owns 90% of the outstanding stock of Waterhole Corporation. So this interest was purchased on January 1, 2019 when Waterhole's book values were equal to its fair value. So the amount paid by Spaniflex Pigeon included 10,000 for goodwill. So January 1, 2013, Spaniflex began purchased equipment for 100,000 which had no salvage value with a useful life of 8 years. So on a straight line basis. So on January 1, 2018, Spaniflex began sold the truck to Waterhole Corporation for 45,000. Okay, so all affiliates use the straight line depreciation method. Okay, so the requirement is to record the entries on the books of Spaniplex for 2018, then record the entries on Waterhole's books for 2018, and give all eliminating entries needed to prepare consolidated workpay for 2018 and 2019. Okay, so um, first we'll compute muna for the amount of gain on sale, no, or loss on sale in the books of the selling affiliate. Okay, so we have here the cost is divided by 100,000, and then the related accumulated depreciation is equal to the cost of the property, no, divide 8 times 5 kasi 5 years na yung property, no, since the date it was acquired. So that's 62,500, and then the carrying amount is 37,500. That's cost less accumulated depreciation. And then the selling price is 45,000 and the carrying amount is 37,500. So we have the gain on sale amounting to 7,500. Okay, so take note that this is a downstream transaction kasi 'di ba yung selling affiliate is si Spaniflex, which is actually the parent, and then the buying affiliate is si Waterhole, which is actually the subsidiary. So first requirement is to record the transaction in the books of Spaniflex Pagan books, the selling affiliate. So to record, of course, we'll debit cash for the amount of proceeds, which is actually 45,000, and debit accumulated depreciation. No, the equipment's accumulated depreciation as of January 1, 2018, which is 62,500. Of course, we'll recognize the equipment at 100,000 and then record gain on sale amounting to 7,500. Okay, so the second entry is to record the transaction in the books of Waterhole, no, the buying affiliate. Okay, so on January 2018, of course, it will debit equipment for 45,000 and credit cash for 45,000. No? So since Waterhole paid 45,000 to acquire the equipment from from its parent. No? So and then on December 31, 2018, so Waterhole or the buying affiliate will record depreciation, no, equal to the cost of the property in Waterhole's books, which is actually 45,000, divide by the remaining useful life of the property, which is actually 3 years. Since 8 years yung 8 years yung useful life less 5 years, diba? So we have remaining useful life of 3 years. So the end would be debit depreciation expense, credit accumulated depreciation for 15,000. Okay, so our next requirement is to give, no, the consolidation work papers, no, working paper, or the eliminating entries for 2018 and 2019. So again, the purpose of our working paper eliminating entries is to bring back, no, the cost in carrying amount of the property. Okay, na and to adjust the accumulated depreciation, no, Okay, na as if the intercompany sale did not occur between the affiliated companies. Okay, so our first entry would be to eliminate the gain on sale and to correct the assets basis. So since the original cost of the equipment is 100,000, and since in the books of the buying affiliate it recorded the equipment at 45,000, therefore to bring back to its cost the 100,000, we'll be debiting equipment at 55,000 again, and then to eliminate the gain, of course, we'll debit gain on sale for 7,500, and then credit accumulated depreciation for 62,500. So the amount we've debited in the books of the selling affiliate on the date of sale. Okay. And then the second entry would be to adjust accumulated depreciation or to record the amortization of our gain. No? So since we do have gain of 7.5 and we have 3 years remaining useful life, so 7.5 divided by 3 is our amortization of a gain. So the entry for that is that to debit accumulated depreciation for 2.5 and credit depreciation expense for 2.5. Okay, so the rationale is that, diba, the recorded depreciation of the buying affiliate is 15,000, diba? So, Waterhole recorded depreciation of 15,000. But for consolidation purposes, the depreciation expense should be the original depreciation, okay? Which is actually 12.5. It's actually 100,000 yung original cost ng property divide 8 its remaining useful life. So therefore, yung depreciation na na-record natin is actually overstated, no, 'di ba? So therefore, we are to decrease the depreciation. That's why we debited accumulated depreciation and credit depreciation expense for 2.5. Okay? Yan siya. So for 2019 naman, so we have actually same entry, no, for 2018. It's just that yung gain on sale, since na-close na siya to retained earnings, of course, you'll debit it to retained earnings na. No? So, still we debit equipment for 55,000 to bring, to correct the assets basis or the assets cost. No? And then debit retained earnings for the gain on sale, which is 7.5, credit accumulated depreciation for 62,500. Okay? And then, of course, to adjust accumulated depreciation and to record the amortization for gain, we'll debit accumulated depreciation for 5,000. That's actually the excess depreciation for 2 years, which is actually 2.5 times 2, diba? And then, of course, we'll credit retained earnings for the previous year's excess depreciation, 2.5, and then credit depreciation expense for the current year's excess depreciation, which is actually 2.5. Okay? That will be the working paper limiting entries natin for 2018 and 2019. Okay, so for problem 2, so we have Pringle Company owns 80% of the shares outstanding of Sealy Corporation. So Sealy Corporation sold equipment to Pringle Company January 1, 2018 for 540,000. The equipment was originally purchased by Sealy Corporation January 1, 2014 for 1,280,000, and at that time it estimated depreciable life was 8 years. Okay, so the equipment is estimated to have a remaining useful life of 4 years, January 2018. So both companies use a straight line method to depreciate equipment. In 2019, Pringle Company reported net income for its independent operations of 3,270,000 for 2018 and 4,250,000 for 2019 respectively. And Sealy Corporation reported net income of 820,000 for 2018 and 950,000 for 2019 respectively. Okay, so the requirements are, of course, to give the working paper eliminating entries, to eliminate this intercompany sale transaction for 2018 and 2019, and also to calculate the amount of non-controlling interest to be deducted from consolidated net income for 2018 and 2019, and also to calculate the controlling interest in consolidated net income or the net income attributable to parent for 2018 and 2019. Okay, so first we'll compute muna for the gain or loss for the sale to be recorded in the books of the selling affiliate. So since the cost of the property is 1,280,000, diba? 1,280,000. And then its useful life is, and it's really the accumulated depreciation, no? We have 1,280,000 divide 8 times 4. Kasi 4 years na yung age ng property, di ba? That's from um, January 1, 2014 to January 1, 2018. That's actually 4 years. So you have 640,000 as your accumulated depreciation, and you have carrying amount also of 640,000. And since the selling price is 540,000, and then the carrying amount of the property is 640,000, you have loss on sale of 100,000. Okay, so to eliminate this intercompany transaction, okay, so first, no, to record the elimination on loss on sale, no? And to correct the assets basis, we'll debit equipment for 740,000. So this is actually the original cost of the property less since, diba, ang pagka-record ni buying affiliate is it will debit its asset or the equipment at its purchase price. Therefore, sa books ni buying affiliate, therefore, may 540,000 na equipment, diba? So therefore, we'll debit equipment for 740,000 to bring back the original cost of the property to 1,280,000. And of course, we'll credit loss on sale for 100,000, and then credit accumulated depreciation for 640,000. That's actually the accumulated depreciation as of the date of sale, diba? No, it's actually 640,000. Okay, then to adjust the depreciation, no, since we do have 100,000 na loss, no, or this is actually the amortization of loss. So since we do have 100,000 as a loss, diba? Then we have 4 years remaining useful life. So 100,000 divided 4, that's actually our amortization of our loss. So we'll debit depreciation expense, credit accumulated depreciation for 25,000. And then since, diba, the buying affiliate will record depreciation at its cost. So at 540,000, no, divide 4, that's actually 35,000, diba? So the buying affiliate will record depreciation at 135,000. But the original depreciation, diba, is actually 160,000. So for consolidation purposes, the depreciation expense should be 160,000, but the recorded depreciation lang in the books of the buying affiliate is actually 135,000. So kulang yung depreciation natin, no, diba? So therefore, we'll debit depreciation expense for the excess depreciation, which is actually 25,000, and credit accumulated depreciation for 25,000. Okay, so for 2019 naman, so the same entry, no? So we still debit equipment for 740,000, and since this is an upstream transaction, no? So yung loss on sale natin, no, will be allocated to the controlling interest and non-controlling interest. So since 80% owned ito, so 20% yung non-controlling interest. So you'll credit retained earnings at 80,000. That's actually 100,000 times 80%, and credit non-controlling interest at 20,000. That's actually 100,000 times 20%. And of course, we'll credit accumulated depreciation for 640,000. Okay, so the end is actually same, no, for the first year. It's just that yung loss on sale natin, no, will be credited na to retained earnings and non-controlling interest. Okay, so the second entry to adjust accumulated depreciation, okay, so we'll credit accumulated depreciation for 50,000. That's actually the 25,000 times 2, diba? No? The excess depreciation for 2 years. Then, yung previous year's excess depreciation, which is 25,000, will be allocated to the controlling and non-controlling interest. So, we'll debit retained earnings for 20,000. That's actually 25,000 times 80%, and non-controlling interest at 25,000 times 20% at 5,000. Then, will debit depreciation expense for 25,000 yung excess depreciation natin for the current year. Okay? So, the second requirement, the second and the third requirement is to calculate the non-controlling interest and net income, and then the net income attributable to parent for 2018 and 2019. So we have here our net income from own operations for 2018. No? For parent, we have 3,270,000, and for kay subsidiary, we have 820,000. And since this is an upstream transaction, therefore we'll adjust the net income of the subsidiary. Okay, since this is an upstream transaction, so to adjust, so in the year of sale for 2018, the year of sale, of course, will add back the loss, no? Because since the net income reported of the subsidiary includes the loss, no? Meaning, nakadeduct na dyan yung loss on sale for the property, plant, and equipment. And then, di ba, we are to eliminate the loss in the year of acquisition or in the year of sale, di ba? So, therefore, i-add back natin yung loss. And of course, we deduct the amortization of loss, no? Which is actually 25,000, di ba? So, therefore, the adjusted net income of the parent is 3,270,000, and then the adjusted net income of the subsidiary is 895,000. So we have consolidated net income of 4,165,000. And then, of course, we'll deduct the NCI share in the net income of the subsidiary, which is actually 895,000 times 20%. No, you have 179,000. So therefore, our net income attributable to parent is actually 3,986,000. Okay, but for the year 2019, okay, and for the year 2019, we have net income from own operations of the parent amounting to 4,250,000, and then for subsidy we have then 50,000. We have 5,200,000 in total. So for 2019, no, this is actually the second year after the sale, no. So we'll adjust lang the loss in the year of sale. So therefore, we'll no longer adjust the loss for the second year. Pero we are to amortize the loss for the subsequent year, no. So we'll record the amortization of loss for 25,000, no. So the adjusted net income of the parent is 4,250,000. Then the adjusted net income of the subsidiary is actually 925,000. So we have consolidated net income of 5,175,000. Okay. The non-controlling interest or the NCI share in the net income of the subsidiary is actually 185,000. That's actually 925,000 times 20%. So we do have net income attributable to parent amounting to 4,990,000. That's actually consolidated net income of 5,175,000 less the NCI share in the net income of the subsidiary, which is 185,000. Okay, so we have here the sample problems in relation to intercompany sale of property, plant, and equipment. So thank you for listening.